Welcome. This episode provides an overview of current developments in the U.S. stock market, focusing on recent market movements, key economic indicators, and stock-specific analysis. The information presented here reflects opinions and interpretations of market conditions and is not investment advice. You should always conduct your own research and make decisions based on your financial situation and future expectations. The U.S. stock market has experienced another significant decline, with notable losses in the Dow Jones Industrial Average. The primary driver behind this drop is the latest Producer Price Index data, which came in nearly double expectations. This indicator is often used to anticipate future inflation trends, and a higher reading typically signals rising inflation. Additionally, the Federal Reserve has indicated that service-related inflation remains elevated. From a technical perspective, the Dow Jones Industrial Average has broken below its 200-day moving average, a signal often associated with the potential start of a negative market cycle. This suggests increased volatility in the near term, with expectations pointing toward continued downward pressure during March. Even optimistic market views acknowledge that persistent inflation could lead to a broader bear market lasting approximately 3 to 6 months. At the same time, Brent crude oil prices have reached $112, reinforcing inflationary concerns. In this environment, two main investment areas stand out. Large-cap companies remain a focus, particularly Microsoft, Meta Platforms, Amazon, and Visa. These companies are currently under pressure but continue to show long-term potential based on their market position and fundamentals. Energy companies are another area of interest, especially those linked to artificial intelligence infrastructure. Constellation Energy is an example, as it is positioned to benefit from partnerships with data centers such as those operated by Google. The increasing demand for energy, including nuclear-based solutions like uranium, is being driven by the expansion of AI and cloud computing. Retail businesses that operate on discounted inventory models also tend to perform well during economic downturns. Companies such as TJX Companies, Ross Stores, and Burlington Stores purchase unsold merchandise from major brands like Nike and resell it at lower prices. These models often attract increased consumer demand when economic conditions weaken. In the payments sector, Visa appears more attractive from a valuation standpoint compared to MasterCard due to a lower price-to-earnings ratio. While MasterCard shows strong future growth driven by innovation, that growth is largely reflected in its current valuation. Visa, however, maintains strong global dominance, particularly in the U.S. market. Regarding Redcare Pharmacy, the stock has declined by 71% this year. Despite the absence of net income, the company shows positive free cash flow, with growth observed both quarterly and annually. EBITDA performance is also relatively strong. However, declining margins have been a major concern. As margins compress, profitability becomes more difficult to sustain. While technology companies often operate with margins near 80%, this company faces higher operational costs, and its 2026 guidance reflects these challenges. In the cloud and AI infrastructure space, Oracle continues to position itself through partnerships. Its relationship with OpenAI highlights the importance of cloud services and data centers for AI development. Even without specific partnerships, demand across the sector remains strong. Meta Platforms is investing billions into data centers and exploring collaborations with Amazon. Meanwhile, Microsoft holds approximately 30% of OpenAI, though this represents only a small portion of Microsoft's overall business scale. Oracle's long-term objective is to achieve strong free cash flow growth by 2027, reflecting broader trends in AI infrastructure investment. In this market, business decisions are primarily driven by financial performance, with the focus remaining on revenue, margins, and cash flow. Finally, in the semiconductor space, AMD is currently considered expensive with a price-to-earnings ratio of 74. In comparison, NVIDIA trades at a lower multiple of 36, making it relatively more attractive from a valuation perspective at current levels. Subscribe to the channel to receive all the latest updates and stay informed about market developments.